Have you ever wondered why some people seem to build immense wealth, while others constantly struggle to grow their bank accounts despite earning a good living? The secret doesn't just lie in how much you save, but in what you do with those savings once they sit idle. In today's video, we are going to break down the exact step-by-step path to transform your stagnant savings into a powerful, wealth-generating investment portfolio. Whether you are a complete beginner trying to understand the basics of the financial markets, an intermediate investor looking to optimize your asset allocation, or an advanced strategist seeking to compound wealth efficiently, this guide will provide you with actionable insights and proven financial strategies to maximize your returns. We will explore how to establish a strong financial foundation, understand risk versus reward, choose the right investment vehicles, and create a sustainable financial future without taking unnecessary risks. Let us dive right in and unlock the full potential of your hard-earned money. Part 1. Assessing your current financial foundation and emergency fund. Before you can begin transforming your idle savings into a robust investment portfolio, you must first establish an impenetrable financial baseline. This begins with an honest and thorough evaluation of your current cash flow, monthly expenses, and existing debt. Beginners need to understand that investing money while carrying high-interest credit card debt is counterproductive, as the interest you pay often exceeds the returns you could realistically expect from the market. Intermediate and advanced investors should also review their financial foundation to ensure that any changes in their personal economy, such as a shift in income or an increase in living costs, do not compromise their core assets. By taking the time to audit your income and expenses, you create the necessary clarity to determine exactly how much money you can safely allocate toward investing without jeopardizing your immediate living situation. The cornerstone of this financial foundation is a fully funded emergency fund, which acts as a safety net designed to protect your investments during market downturns or personal financial crises. For most individuals, holding 3 to 6 months of essential living expenses in a highly liquid and secure account, such as a high-yield savings account or a money market fund, is a prudent strategy. This reserve ensures that if you face an unexpected job loss, medical emergency, or major home repair, you will not be forced to liquidate your investment portfolio during a market decline. For more advanced investors, this fund serves a dual purpose as a dry powder reserve, allowing them to capitalize on sudden market corrections without disturbing long-term compounding assets. Establishing this fund is not just about hoarding cash, but about creating the psychological and financial security required to take calculated risks in the broader markets. To further solidify your foundation, you must aggressively address any high-interest liabilities before redirecting your savings toward long-term wealth accumulation. Make a comprehensive list of all your outstanding loans, noting the interest rates and principal balances for each one, and prioritize paying off the debts with the highest rates first. The logic behind this is simple yet mathematically powerful. Paying off a debt with a 20% interest rate provides an equivalent, guaranteed 20% tax-free return on your money, which significantly outperforms the historical average of the stock market. Once your high-interest debts are eliminated and your emergency fund is fully secured, you will have established the ultimate financial launchpad. At that point, any additional savings can be seamlessly and safely redirected into growth-oriented investment vehicles without the constant anxiety of a potential financial emergency derailing your future. Part 2. Understanding the mechanics of inflation and purchasing power. When your money sits idle in a traditional savings account, it is subject to a silent tax known as inflation. For beginners, it is crucial to understand that inflation represents the rate at which the cost of goods and services increases over time, meaning your dollar buys less in the future than it does today. If inflation averages 3% annually, the purchasing power of your money is effectively cut in half in roughly 24 years. Intermediate and advanced investors often look at real returns, which are calculated by subtracting the inflation rate from the nominal investment or interest rate. If your savings account yields less than the current inflation rate, you are actually losing purchasing power year after year, even if your account balance appears to be growing on paper. To comprehend the true cost of keeping money in cash, consider how everyday expenses have escalated over the last few decades. A cup of coffee or a gallon of milk that cost a fraction of the price 20 years ago now requires significantly more dollars, demonstrating how the currency depreciates. While cash offers absolute nominal safety and protects against market volatility, it exposes you to purchasing power risk. If you are aiming to build long-term wealth, your capital needs to generate a rate of return that exceeds the inflation rate just to break, even in real economic terms. This fundamental truth is the primary reason why shifting from saving to investing is not just an option, but a financial necessity to maintain and grow your wealth. Investing in assets like stocks, bonds, and real estate allows your money to grow at a pace that typically outpaces inflation over long horizons. Historically, the stock market has provided average annual returns that easily exceed the historical inflation rate, allowing investors to increase their actual purchasing power over time. When you invest, you are effectively buying a piece of productive companies or assets that can raise their prices and increase their revenue in tandem with inflation. Transitioning your capital from cash to these investment vehicles protects the future buying power of your money and harnesses the power of compound interest, transforming a depreciating asset into a growing engine of wealth. Part 3. Choosing the right investment vehicles for your risk profile. Selecting the appropriate investment vehicles requires a clear understanding of your personal risk tolerance, which dictates how much market volatility you can endure without panicking and selling your assets. Beginners should start by evaluating their capacity for risk, considering factors such as their age, income stability, and time horizon until they need to access the funds. Conservative investors who prefer capital preservation might allocate a larger portion of their portfolio to fixed income assets like government bonds or high-yield certificates of deposit, which offer lower returns but higher stability. On the other hand, intermediate and advanced investors who are focused on long-term capital appreciation usually take on more volatility by heavily weighting their portfolios toward equities, real estate investment trusts, or growth-oriented funds. Matching your risk profile to your chosen assets ensures that your portfolio aligns with your psychological comfort and long-term financial objectives. Once you define your risk tolerance, it is essential to understand the mechanics of the various investment vehicles available in the market. Individual stocks represent partial ownership in a single company, offering the potential for high returns but also carrying substantial company-specific risk. Mutual funds pool money from multiple investors to purchase a diversified portfolio of stocks or bonds, but they often come with higher expense ratios and management fees. Exchange-traded funds combine the diversification of mutual funds with the liquidity and lower costs of individual stocks, making them an excellent choice for a wide range of investors. For advanced investors seeking additional income streams, options and real estate assets provide ways to generate cash flow while potentially appreciating in value over the years. Understanding the underlying mechanics and fee structures of these assets allows you to make informed decisions that minimize unnecessary costs and maximize your net returns. Diversification acts as the final and most critical layer when choosing your investment vehicles, ensuring that the poor performance of a single asset does not severely impact your entire portfolio. By spreading your capital across different asset classes, sectors, and geographic regions, you protect your wealth from localized economic shocks or industry-specific downturns. Beginners can achieve instant diversification by utilizing broad market index funds that track the entire economy, while more advanced individuals can add international equities, emerging markets, or alternative assets to their core holdings. The goal of this process is not to eliminate risk entirely, but to manage and optimize it so that your money works efficiently for your specific timeline and future aspirations. Evaluating and adjusting your asset allocation periodically ensures that your portfolio remains balanced as your financial situation and risk tolerance evolve over time. Part 4. Building a diversified portfolio with low-cost index funds. Building a diversified portfolio does not require you to pick individual winners or constantly monitor the stock market. Low-cost index funds allow you to own a tiny slice of hundreds or thousands of different companies in a single transaction, providing instant diversification and significantly reducing the risk of a single corporate failure, destroying your capital. For beginners, this eliminates the steep learning curve and the emotional stress associated with analyzing individual stocks, offering a straightforward and proven method to participate in the growth of the overall economy. Intermediate and advanced investors often use index funds as the foundational core of their portfolios, surrounding them with tactical or sector-specific investments while maintaining low overall expenses. Understanding the impact of fees is absolutely critical when selecting index funds for your portfolio, as high expense ratios can silently consume a substantial portion of your long-term returns. Actively managed funds often charge management fees that can range from 1% to 2% annually, which might seem small, but will compound into tens of thousands of dollars in lost gains over a decade or two. In contrast, index funds and exchange-traded funds typically carry expense ratios of a fraction of a percent, sometimes as low as 0.03%. This massive difference in cost means that more of your money stays invested, allowing the power of compound interest to work at maximum efficiency. By prioritizing funds with the lowest expense ratios, you are actively taking control of your financial destiny and keeping your investment costs exceptionally lean. To construct a well-rounded portfolio, you can combine a few complementary index funds that cover different asset classes and geographic regions without overlapping excessively. A common and highly effective approach is to hold a broad market index fund that tracks the top domestic companies, paired with an international index fund that captures global economic growth outside of your home country. For those who want to add a layer of stability, a total bond market index fund can be integrated to cushion the portfolio during market downturns. This simple yet sophisticated allocation strategy creates a highly resilient portfolio capable of withstanding various economic climates. By allocating your capital into these funds regularly, you remove emotion from the equation and build wealth consistently over time. Part 5. Automating your contributions for long-term wealth creation. The most effective way to ensure that your savings transform into investments consistently is by removing the emotional decision-making process entirely through automation. Human psychology often tempts individuals to try and time the market, waiting for the perfect moment to invest, which frequently results in missed opportunities and cash sitting idle. For beginners, setting up recurring, automated transfers from a primary checking account into a brokerage account immediately after receiving a paycheck guarantees that you pay yourself first before any lifestyle inflation consumes your money. Intermediate and advanced investors use this same disciplined approach to enforce a strict savings rate, ensuring that their capital is continually put to work without requiring constant manual intervention or emotional willpower. By automating your contributions, you naturally implement the financial strategy known as dollar cost averaging, which smooths out the effects of market volatility over the long run. When the market experiences a downturn, your fixed dollar amount purchases a higher number of shares and when prices rise, it purchases fewer shares, ultimately lowering your average cost per share over time. This mechanism eliminates the stress of attempting to predict the bottom of the market and allows you to accumulate wealth quietly in the background. Whether the stock market is reaching new all-time highs or enduring a deep correction, your investment engine continues to run, steadily building your financial future while you focus on your career and personal life. To scale this process for maximum long-term wealth creation, you should also automate the reinvestment of dividends and capital gains, allowing your portfolio to compound exponentially. Many brokerage platforms allow you to set your dividends to automatically purchase additional shares of the underlying assets without any transaction fees or manual effort. Advanced investors can take this a step further by coordinating these automated personal contributions with employer-sponsored retirement plans, optimizing their tax advantages while maximizing the growth of their portfolios. By creating this seamless and automated loop, you transform the accumulation of wealth from an arduous, active task into a passive, background habit that operates continuously throughout your life. Transforming your hard-earned savings into a wealth-building investment portfolio is the most critical step you can take to secure your financial freedom and build lasting generational wealth. By establishing a solid emergency fund, protecting your capital from the silent tax of inflation, aligning your investments with your personal risk profile, and utilizing low-cost index funds through automated contributions, you ensure that your money works for you rather than just sitting idle in the bank. If you found this step-by-step path valuable and want to continue learning how to grow your net worth, please subscribe to the Sam Invests channel and hit the notification bell so you never miss a video. To help us spread financial literacy, leave a comment below with the phrase, "My money works for me," and let me know which of these steps you are implementing in your finances starting today.